When you're in launch and pre-launch phase and you want to build wealth, you got to get all four pillars at their max value. You got to have the fire and steam of the four pillars fighting for you as hard as you possibly can. Hello and welcome back to the Main Street Patriot Podcast. My name is Jimmy Vreeland. I am the Main Street Patriot. I'm the guy leading the team that is out on the streets finding properties for the non-institutional investor while there's still properties available for the non-institutional investor. With me as always is my producer Jake. Jake, say hello to everybody.
How's it going, everybody? Jimmy, good to be here with you again.
What are we going to talk about today, Jake?
Single family versus multifamily, from what I understand. I'm pretty excited about it. I was looking at some of your notes for this, and I think people are really going to love this because it really turns a couple things on its head. I'll just say that.
Well, you've been peppering me to record this one for a while. Why is it that this is so fascinating? Why do you think this is such a hot topic?
Yeah, well, I think... people hear about, REITs or syndicates and, hey, I could invest in real estate, but just by giving my money to somebody else. And is that the easiest, fastest path to wealth and success? Is kind of, I think, the question that's out there versus building up like a portfolio that I have to own and be responsible for and everything else. And so I think it's a hot topic, so I'm excited to hear your perspective on this.
Okay, yeah, and so to warn the audience, before I really get into the quick answer, I'm going to have to, kind of introduce a couple of frames. We're going to have to kind of talk about a couple things before I just blurt out the answer, because just blurting out the answer, one, it's not that much fun, it's not intriguing of a podcast, and it's not kind of how I came to my decision. But Jake, before we get started on that, if you guys are interested in working with me and my team and to start building a real estate portfolio passively or running some flips passively, please go to jimmyvreeland.com/get started in real estate, and you'll have a link to schedule some time with a team member to see if we're the right fit to work together. So let's start getting into single family versus multifamily. I think what you got to recognize, Jake, is you're an American, you won the genetic lottery, so you're going to win pretty much unless you mess it up. And I don't like dogmatic thinkers who are like, I hate the stock market, real estate's the best, or real estate stinks, or single family's the best, and unless you're doing single family, you're stupid, or syndication's the best, and those single family guys are suckers. It's like a lot of times it's not an either or, it's a matter of when. And then, people get so, it's 2025 and people are so get fired up about their opinions on things. And it's just bottom line, dude, is you're in the most abundant economy in human history. As long as you're good to others, create value, and do your best, you're going to win.
You're going to have food in your stomach and a roof over your head and get to watch the Blues play.
Yeah, if you're a hockey guy, and just the way people get so fired up, oh my God, if you do this, you're going to lose and everything's going to be horrible. It's no, life insurance, real estate, the stock market, no matter what, you're probably going to win because you're the most abundant economy ever. So what we're discussing is get rich in your niche. If you're newer, what niche do you want to get rich in? And then when is it time to go get rich in what niche? I think there's also a time component people miss out on a little bit. And so the first kind of frame I'm going to introduce, it's called the wealth pyramid framework. And okay, so what I'm going to introduce, gang, is I'm going to discuss what's called the wealth pyramid. I'm going to discuss the phases of wealth building. I'm going to talk about how you maximize the four pillars. Then if we got time, I'll do a case study. and then talk about the greatest advantage of done-for-you real estate and doing it passively, and talk about what you're never going to achieve with syndications. Does that sound good, Jake?
That sounds awesome. I'm excited.
And so this is a podcast where at least the first 5 to 10 minutes of it, watch the YouTube recording, because I don't think I'm going to waste the whole audience's time going through the visual of the wealth pyramid. But if you're driving your car, I try to imagine a pyramid and where you got different layers. And so the bottom layer, the foundation, is produce. Like, passive income comes after hyperactive active income. Like, there's no real point in worrying about getting wealthy unless you first are going to produce something for other people. Does that make sense, Jake?
Yep.
So once you've got production going, and then that's the other thing why I like the pyramid analogy, is you're always trying to build out the base of your pyramid by creating more value and becoming more productive. And then generally the way you do that is from skill sets, mindsets, and networks. And so after you got production done, you got another layer called insurance, liquidity, and a hedge. And so what insurance means is like property insurance, life insurance. You want to hedge your risk. You want to be able to diversify your risk amongst other people. You don't want to have to own all of it. Luckily, there's actuaries and insurance companies that cover your risk for home insurance, auto, life insurance. Like, if you have done a great job building out the production base of your pyramid, you probably want to insure that risk if you are the main income earner in your family. But we could probably do another episode on how insurance and life insurance kind of mixes into wealth building, but subject to another podcast. This is, so for the most high producing W-2 employees, this is a big gap I see in their game, and it is liquidity. And so if you're going to gain wealth, you generally need some form of liquidity. And then people's biggest problem with liquidity is they're like, oh, if it's just sitting in cash, it's getting eaten up by inflation, and I'm not getting a high enough return on that. And it's like, that I agree with you, but there is a return on having liquid cash available at any moment, not just peace of mind wise, but if you have a great opportunity, being able to liquidate that deal. So people have a bunch of cash locked up in qualified plans. Qualified plans are great. At the end of the day, you're going to win. Remember, you're an American. The problem with it is it's not liquid. And so if you have the greatest opportunity ever come across your desk, a lot of times you can't jump on it. And so you got to have, like when I first started, it was 2 months of expenses, then 3 months of expenses. This is something you got to work out on your own. How many months of expenses do you want to have sitting aside? And so, like for me, I want my business not to have to make $1 for 90 days and us still be fine. So that's how I match my liquidity reserve. Does that make sense, Jake?
Yeah. I mean, I think it's a little counterintuitive because most people don't think about that as a tool to build wealth, but it makes a lot of sense.
And then most highly paid W-2s, they're not generally very liquid because a lot of their wealth is stacked up inside their qualified plan. So just something to think about. Mm-hmm. And then if you're a small business owner listening to this, you got to have liquid funds available just in case your business hits a snag. And so that's why me personally, I don't invest in 401ks and whatnot because I got to have liquidity as a small business owner. Then the next part of that base is the hedge. Hedge means gold, silver. Like right now, I think I have $10,000 in metal. I want a couple months of, if the worst happens, that I can get by on a non-cash based economy because if the end of the world comes and we got like Walking Dead happening, we got other issues. But let's say there was a global economic snag and something happened with the electronic money supply, I'd still want to be able to trade.
Sure.
Next after that is then a business or investment real estate.
So it's kind of like the third tier of the pyramid.
Correct. Because a business or investment real estate has the 4 pillars. They appreciate, they cash flow, you can use leverage, and there's tax advantages. Mm-hmm. And now this is where I think a lot of people get kind of confused. And now the level above that is generally something like oil and gas. The level above that is I don't have all the 4 pillars. So oil and gas, syndicated real estate, and private lending. Oil and gas, syndicated real estate, private lending, great investment options, phenomenal investment options. And I'm going to get to this in a second in the podcast, but they don't have all the 4 pillars. And you might be saying syndicated real estate does, and I'm going to say no, it doesn't. And we're going to kind of talk about which pillar you're giving up. Private lending's a great way to make money. When I first started, my first deals were private loans. Problem with private lending is you don't get appreciation. You do get cash flow, and you can't use leverage, and you don't get tax advantages. But I still made a great return. Now the level above that is legacy stocks and loans. And so,
by legacy
generally at that
stocks,
point,
you mean like publicly traded on the stock market?
Yeah.
NASDAQ?
Yeah. Because really, you have one pillar with the stock market. Still a great investment, just you only have one pillar. And then finally above that is IRAs. Because you have one pillar, you have some tax advantages, but the liquidity thing for me is why, that's the last thing you do. And I know that's a completely counterintuitive idea. And then maybe the exception is, you do your company's match, because it's technically free money.
Sure.
That it's just not liquid, but whatever. So my belief, if you're driving around in the car, is that traditional financial planning has the wealth pyramid flipped up on its head.
Totally upside down.
Yes. They have production, then straight to IRA, then to stocks, then to oil, gas, syndicated real estate, private lending, then business, then your own real estate. So then you spend money on life insurance, then you worry about your liquidity, and then you worry about your hedge. Does it make sense how it's kind of backwards?
Yeah, so it looks pretty unstable, Jimmy.
Yeah, I mean, that point too, because it's all on your production as well. But the fact that you want to maximize your 4 pillars as you're growing your wealth. Now, if you are this is in one of Ray Dalio's books, but if you're a huge family office and you have like $1 billion around, you're looking for safety and stability and like a 4% yield. Because 4% yield on $1 million is what, $400,000?
Yep.
That's real scratch. And so if you already got the wealth, I think the traditional financial planning paradigm is great. If you're trying to grow it, we're in a different situation. Does that make sense?
Yeah, you got to protect what you have. But that's to the point you were making earlier. Like, that's where a lot of people are starting, though, is they produce and then they're putting money into the 401.
Yeah, the IRA, the 401k, because the HR director or the financial planner, and I think they have the wealth pyramid upside down.
Yep. Wow.
And so I want to introduce one other frame in here, and it's called the producer framework. And so there's 4, as you want to grow wealth, there's kind of 4 stages. You got pre-launch, you got launch, you got gravity, and you got orbit. And so what's pre-launch? So pre-launch is you're really working on skill sets, mindsets, networks, a game plan, and frameworks and structure. So it's almost like a rocket, Jake. Like, you see the new Tesla rocket when it's about to take off?
Yeah.
There's a bunch of steam and billowing, but it's not moving.
It's just sitting there. Yep.
And so if you're going to grow your wealth in real estate, this is like, you saw something on Instagram, you're watching a new course, you're getting a bunch of new ideas put into your brain and trying to figure it out. And so mentally, it's really taxing, and you're learning a lot and you're growing a lot, but you're not seeing a lot of action.
So that's interesting, because I was talking to a guy recently, and he was talking about the ways that basically any employee provides value to an employer. And he was talking about, I think he kind of divided up into like 6 different ways. But it's like you save money, or you got to make money, or you got to give them peace of mind, or whatever. So these are like kind of these mindsets and skill sets that you're talking about, that they do produce, but it doesn't necessarily feel like things.
But you don't feel a lot of movement.
Gotcha.
And so I was playing basketball with my 10-year-old last weekend, and I wanted him to start doing left-handed layups. And he's like, "Dad, I don't want to do left-handed layups because I look stupid." I was like, "Well, dude, that's like the game. Anything you start that's new, you're going to look stupid. And you should have a beginner's mind. You should be willing to be the fool." And
Yeah.
so that's the pre-launch stage. So a lot of people in our community, they come in, they watch the course. At that point, they're in pre-launch stage. And they're like, Jimmy, I'm watching a ton of videos, but not a lot's happening. And I'm like, okay, cool. Well, then you're probably ready for a deal.
But it's like they already got something is happening because they got this knowledge that they didn't have before,
Yeah.
and nobody can take that away from them. They're always going to have like sort of some correct ways of thinking about real estate, and so something is happening, even if like it's just this kind of that smoke and fire on the ground, like you were talking about.
Yeah, it's just like a rocket. And so now you got launch phase. And if you know a rocket, it's like there's still a bunch of fire coming out, but now you're moving.
Yep.
And so this is like what I would say is like someone's houses 1 through 5. Like they're moving, they're learning, but like that first house is like a pain. Like I gotta get pre-approved by the lender. I gotta sign all this paperwork. I gotta read all the paperwork. So like when I close a house now, I just start signing because I know all the documents. Mm-hmm. But the first house I bought, I read everything with like, I'm not a detailed person, but I read everything in as much of a detailed manner as I'm able to do.
Right.
And so this happens for people in our community between like years 1 and years 3. But it's between your first 1 to 5 to 10 houses. I call that launch phase. And then you have gravity phase. At this point, you have systems and processes. You maximize your 4 pillars. You're starting to seeing that compound cash flow, and you're starting to build wealth. And that's between years 1 and 3. And so I bought the majority of my portfolio in 2016, really in my launch phase. And now I've held these like 60 to 70 houses for 9 years. And for me to buy a house, it used to cost me like 10 hours. Now I can buy a house in like 30 minutes because I got systems, I got processes, I have a team, but it's because I'm in gravity stage. And then finally, this is a stage everybody wants to get to, but it's the orbit stage where, maybe you're not buying anymore, but your assets are kicking off passive income. Your assets have built so much equity, you can equity mill and do lines of credit. And so it just feels different, and there's different stages. And you'll notice, like when a spaceship's orbiting the Earth, there's no fire, there's no steam. It looks like they're just chilling, right?
Yep.
And so I'd say the 4 stages of building wealth to kind of set a frame of when single family, when multifamily.
So we talked about in a previous episode that putting up that inflation sale, and that's the thing with that appreciation that's really going to drive a lot of wealth.
Yeah,
for folks, and so that's like you're in orbit now. There's no more fire. There's no more smoke. You're going. You're just going.
Exactly. And so the question single family versus multifamily isn't the right question. The question is when single family and when syndication.
Okay, why?
And I'm going to kind of get into that.
Yeah.
And so it comes down to maximizing the 4 pillars. And so when you're getting started, when you're in orbit phase, or when you're in launch and pre-launch phase, and you want to build wealth, you got to get all 4 pillars at their max value. You got to have the fire and steam of the 4 pillars fighting for you as hard as you possibly can. Does that make sense?
Yep.
And now most people will be like, Jimmy, what do you mean there's a pillar missing in a syndication? Because they do appreciate, they do cash flow, they do have tax advantages, and they do have the ability to use leverage, right?
Right.
And so I'm going to they're there in a syndication, but they're not maximized. The 4 pillars are not maximized.
Actually,
and I'm going to kind of explain
leverage
that.
real quick for me.
Yeah, the ability to use other people's money, the ability to use lending.
Okay, so because you're buying into the syndicate, the other people are too, so there's leverage.
There is leverage, but it's not maximized.
Okay, all right.
So in any syndication, you got A shares and you got B shares. A shares go to the syndicators, the people actually doing the work. The B shares go to the people who are the sponsors, the cash investors. Make sense? So now A shares, These are the people that are bringing the talent and energy to the deal. And what they do is very complex. It's not easy, and they need to be compensated. They get compensated through equity, and they get compensated through their salaries in the deal. A lot of times they're taking management fees, but they're the active component. Now, this can offend a lot of people who are investors, but passive income comes on the heels of hyperactive active income. And so someone has to do the work, and it's the A share people. And then this is where B share people get offended. They're like, I'm bringing the cash, and like, no offense, this is coming from somebody on the inside who does a lot of active work. Cash is the easiest thing to find. It's not that special. And so I say this to people who have cash, and they get a little offended.
I'm not special.
It's just cash. You're not bringing any talent or energy. Like, now granted, I'm biased because I'm on the inside. And somebody who's just a cash investor, I could see them being biased. They're like, I'm really important. I have cash. Like, how does that line, what do you think about this line?
Well, maybe I'm a little bit biased because, I've kind of like been observing in society, the everybody gets a gold star kind of thing. And, that line of, everybody's special. It's like, well, no, that's not true, right? It's not true. Someone has to be able to specialize at something. And so they're actually bringing something to the table in this particular instance.
It's not the first thing I'll say, but there's been a few times in my career where I've worked with wealthier people who were money investors, and I've had to tell them, hey, bro, you're not that special. Cash is the easiest thing to find in the deal.
Right. So if somebody is out there, a high performer, maybe they're a doctor, maybe they're a lawyer, and we're definitely sent them the message that they shouldn't be thinking about trying to get out of their 9 to 5 because they have a cash machine. Like, hey, like, newsflash, you're not the only person with that cash machine. You should stay in there. But when it comes to real estate, you're not that special.
Well, here's an interesting idea. These doctors, lawyers, sales professionals, when they're in their zone of genius, in their active component, they're crazy special.
Boom.
They're very valuable. But when they want to step back and just be the cash guy, they're just not that they're not that special. There's plenty of cash out there.
Especially in America, the most abundant society on earth.
Well, in an inflationary environment, cash is begging for yield right now. Cash is begging for safety, and it's begging for yield. So it's commodity.
Not that
So
special.
for any of you rich people listening, if I may have offended you, that your cash doesn't make you that special, like, please forgive me.
We could send you a therapy puppy in the mail.
Exactly. And so let's go back to the basic deal. And then generally, A shares and B shares split 50-50. And then generally there's a preferred return. So a lot of the cash investors like the cash flow of the preferred return. I get my 7-8% no matter what. Now that brings up other certain liabilities. Generally a Ponzi scheme, and I'm not saying syndication's a Ponzi scheme. I'm saying this is how Ponzi schemes work, is they pay the new investors first, and then eventually someone gets the short end of the stick. But when you're investing in a syndication, the cash flow you're getting is it's like a safety blanket. It doesn't mean you're going to get your waterfall. It's not an indication that you're going to get your end waterfall. And then a lot of times a preferred return means, hey, when the cash is there, you get your preferred return, but it's still not guaranteed.
Whoa. Okay. So you, in these scenarios, they're giving you a little bit as like a
preferred return.
Right.
Something to make you feel good about it.
Right. But it doesn't mean the property is going to actually do that well and you're going to get a waterfall.
Yeah, there doesn't make it a guaranteed. It's kind of the peanut butter that gets you to take the pill to invest. Where owning your own single family rental, sometimes you always don't get 7% in cash flow. Sometimes there's maintenance. Sometimes there's all that. The thing is, The same thing's happening in a syndication. It's just they have a pot of cash to pay that preferred return out of. But eventually if the unit is not making money, that cash you're getting today is just coming out of your waterfall. And the waterfall is why you really are into it. And so with single family, your waterfall goes all to you. And I'm going to get into that. Okay, so here's the basic waterfall. You get a 7% pref. You get the waterfall event. Either you do a refi or you sell the unit, right?
Right.
And so at the waterfall event, a 7 to 15% return is generally split 30 to the A shares, 70 to the B shares. Now, don't get wrapped around the details. This is a basic deal.
Yep.
And now after a 15% return, the profit shares are split 50-50. And so
over what kind of time period is a deal like that usually?
Generally 3 to 5 years. But when interest rates went up, like everybody stopped getting the preferred return and the waterfall event got pushed like years.
Right. No, that was all over the news. A couple months ago, you open up the Wall Street Journal any given week, and there's some article about how all these syndicates, like, that happened. Sometimes they even have the liquidity to manage that.
Exactly, and it comes down to a liquidity game for the syndication, and I've seen these happen. So here's what I mean. Yes, there are 4 pillars, but they're not maximized. You do get cash flow, a 7% pref. You do get appreciation, but it's split in half. Because what does the syndicator want? They want their management fees, and they want the big waterfall event when they sell the unit. And so what does the house flipper want? On a single family, same thing. But in a syndication, you split the appreciation in half. And is there leverage? Is the syndicator going to a bank and borrowing money? Yes. But once again, the benefit or leverage are split between A share and B shares. And so if you're not in launch mode, you might not care if it's split. But if you are in launch mode, you need to maximize all 4 pillars. Taxes. Are there tax advantages? Yes, but they're split in half. And so if you're in launch or pre-launch mode or really in growth mode, do you want to split up those benefits, Jake?
No, you're not going to have enough smoke and fire to get the rocket up.
Exactly. And so, once again, everything's split in half. And so the B shares put up all the cash, but only get 50% of the benefits of taxes and leverage. So if you're saying to yourself, do I want single family or multifamily? It's like, okay, cool. Do you want to split the benefits of real estate in half? And if you do, you should probably do syndication. So the advantage, I'm gonna get into the advantages of the syndication. Now, with a single family home, you get 100% of the appreciation, 100% of the amortization, 100% of the cash flow, 100% of the depreciation, which you need when you're in pre-launch and launch phase.
Right.
And so who do syndications work for? I think they work for people in orbit phase who have a bunch of capital and want to deploy it fast. Now, a little downside of single family is you can only, deploy so much cash at a time. If you're buying a $200,000 house, the maximum amount of cash you can deploy is $200,000.
Right.
And then with syndications, you can't really work the Burr plan of forcing equity and extending capital.
Right.
So you can't be into an asset for only 5% down like you can with some of the Burrs we work with people. And so now we have to get into what internal rate of return is, because also in syndications, you're going to see they're all advertised off the waterfall event and internal rate of return. Mm-hmm. And so there needs internal rate of return.
Like fine print for them. Everything else is like,
It's not really fine print. It's just something as an investor, like this is where I do think you're going to get value out of this podcast, understanding the concept of internal rate of return.
Okay.
And I'm going to do my best to explain it because it took a little bit for me to understand. So why can't you just have rate of return? Well, you had to have a term for internal rate of return because how do you account for time in an investment? So if you're going to carry an asset for 10 years, it's like, how do I account for the annual return when you're trying to compare apples and oranges? When somebody's like, I got this rate of return this year. But if you're like, wait a minute, I got an asset I'm carrying for 10 years. How do I know what return I got that year, right?
Right.
So it calculates.
Make a specific year.
Yeah. Okay, so the simple definition of IRR is this. It's the total projected returns divided by the amount of years it takes to make that return. Does that make sense?
The total projected returns divided by the amount of years that it would take to make that return.
Yeah, because most syndications, they run their numbers on an IRR. Okay. And so they say you're going to have a 17%. Most deals are going to be between a 12 and 17, probably 12 and 20% IRR, right?
Right.
And that doesn't mean you're getting a 20% year one. Doesn't mean you're getting a 20% year two. Basically what they do is say, this is going to be your total return when we sell the asset. And then they say, hey, are we going to sell it in 5 years or 7 years? And it's a projected when they're going to sell it.
Sure. So if you think that your return on your investment is going to be 20%,
call it 100 grand.
Okay. So you're going to get 100 grand or 100 grand investment.
You're going to get $100,000 return, like when you sell a syndicated asset.
What did you put into it?
Call it 20.
Okay, so 20. So you're going to get
a 5 times return.
5x return. But that's dependent on how many years it takes to get that back.
Yeah.
Got it.
So if it was a 10-year asset and you made 80 grand off it, that's an 8% return that's an IRR of 8. Mm-hmm. And now, so this is a little bit of smoking mirrors. Most syndicators go on IRR based off the waterfall event. So if they project a waterfall in year 5, but it takes 7 years, your IRR just dropped. Right. It got divided by 7 instead of 2. Right. And now this is where single family people make a huge mistake, is they only say what the return on a single family asset is in cash on cash return. And that's stupid. Single family people like me need to be talking more like syndicators and talk about the IRR of the asset. And remember we did that episode on put all the 4 pillars together and generally you get a return of over 30%?
Yep.
Same thing, that's IRR.
Right. Okay.
And so if you hold a single family asset for 10 years and you get your waterfall event when you sell the house or you do the refi. But if it's a $200,000 house and you put 20% down, we've done this in other podcasts. So that's a $40,000 investment. If it appreciates 10 grand in the first year, and so you got 40 grand in the deal, you got 10 grand back, that's a 25% return, year one. Plus you throw on the 8 to 10 for cash flow, now you're at 33%. So for single family, generally the IRR all day long is 33%. And by the way, the IRR you're splitting with the syndicator is what you're splitting. It's not all yours. With single family, it's all yours. So once again, if you're trying to maximize your return, you got to go single family. And then also the IRR, the dependence on the return for most syndications is the waterfall event, which is a projected date.
What is dependence of returns?
Dependence on returns is, so IRR, you got to have the waterfall event to realize your IRR, right?
Right, okay. Right.
So it's dependent on the projection when you actually sell. Like I said earlier, if you say you're going to sell in 5, but it takes you to year 10, your IRR drops a lot. And so you're just saying, when I see people analyzing syndications, they're like, oh, well, this syndication says this. And I'm like, sure, bro, but that's a projected date.
Right. So what you're talking about is that there's a certain probability that you'll get your return within a certain amount of years, and it is dependent on that in order to get that IRR.
It's all about the waterfall event, where single family is not all about the waterfall event.
Right.
So Jake, like single family is just like this beautiful crock pot where it appreciates 5% a year. You only put 20% in the investment, and it's just like, it's almost impossible not to get like this 25% return year over year. And like, we did another podcast where we got data since the Battle of Midway. The average price has gone up in the United for a single family home has got up 5% a year. So it's almost like a no-brainer.
Right.
So I'm going to list out for the audience the pros of single family and the pros of syndication. So you don't think I've been dogmatic on this, have you? I don't want to be dogmatic.
No, I think I hear clarity on, hey, this makes sense if you're in orbit, but if you're like at the bottom of your wealth, not bottom of your wealth period, but you're still building up, like that the single family real estate investment where you are the sort of active participant really makes sense.
Cool.
I don't hear dogmatism here.
Good. Because it really annoys me from when I get it from anybody, even single family guys. So here's the pros of single family. You maximize all 4 pillars. You get a consistent 30% IRR. It increases your learning curve in launch. You're also learning to become investors, so you'll be a better syndication investor one day. And the other thing is allows you to trade up. If you own a house, 10 houses for 5 years, you sell all those, you use that cash, and maybe then it goes into syndications. And then also, single family allows you for the most control. I've had a lot of syndication investors come to me for single family because they want the control. And it's like, cool, I get it. That's important to you. That's what you should do. Now, pros of syndication is that all 4 pillars exist. They're just not maximized. And then generally, can expect a 15 to 20% IRR after the waterfall. You get to deploy capital fast with little brain damage. And you get one transaction to put a bunch of money to work. What's up? What's funny?
I'm laughing about the brain damage. But contrast that with, you said, a steeper learning curve on the single families. So you're saying...
no, steeper learning curve on the syndications because there's more risk.
Okay. I thought
you got to do more transactions in single.
Increased learning curve on single families.
I mean, you get to learn faster with less risk.
Okay. Sure.
So, you buy a $150,000 house, like little bit of risk, but you get to learn all the stuff.
Right.
Dumping $200K into a syndication, big risk, big reward. And you got to do all the lawyer paperwork. You got to do it's different brain damage.
Sure. Right. Nice. I think it goes back to, I mean, in a sense, the education that you're getting with the single family is invaluable, like you said.
It's been invaluable for me, and I think a bunch of our clients. So here's the cons of single family. It's more cumbersome to deploy capital. There's a transaction time cost to, go to the title company and sign for 20 transactions instead of 1. And then probably you're going to spend more time tracking your results over time because you don't just get some sophisticated financial document from the syndicator. Right. You get property management statements from the property manager.
Right.
Now, the cons of syndication. Not all 4 pillars are maximized. You also have less control. You have lots of capital tied up in one deal. So there's one deal risk there. Returns are weighted heavily to appreciation. Much more interest. These are much more interest rate sensitive because you can't get 30-year fixed loans for syndications. And then you have a potential risk for cash calls because there's balloon payments on the leverage.
Sure. But you might still have that risk with the single family. It's not going to be called a cash call, but you might need to put some money into it.
Yeah, with maintenance. A maintenance cash call, a tenant moved out cash call is much different than a syndication cash call. Like a cash call like, hey bro, we have a balloon on our loan and the bank's changing the terms and we need more cash in the deal. That's completely different. And you never have that risk with a 30-year fixed mortgage.
Right. Yeah, that's a very different experience.
Yeah. And so now the other thing, as you're trying to maximize this, and we have a lot of people in our community are married couples and they want to have one person in the relationship come home and become a real estate professional and get massive tax savings, which I call the holy grail of real estate investment. You'll never gain real estate professional status from syndications.
Really? Okay, because you're not active.
Correct. Unless you become a syndicator yourself.
So the syndicator, do they get to benefit?
Yeah,
from
they're
all
real estate
four-
professionals. Yeah, they get it all day.
And they get all four pillars too?
They probably get more than all four pillars because this is their active income. They're using other people's four pillars.
Okay. Yep.
That's kind of the approach. They're just the cash person.
Right.
And so, hey, let's split up the four pillars.
Sure. And it's hyperactive income for them.
Exactly. I mean, that's their active income. They're not doing anything shady. They're not doing anything wrong. That's how they make their money.
Sure. Right. Yeah. That makes a lot of sense.
But I just think it helps to have the frame of the A and B share person. Because,
Yeah.
like, look, if you're really wealthy and you don't need to do much active income, syndications are great for you.
Assuming you know what it is and you know how to analyze it and get into it.
Yeah.
Because if you're putting all that into one deal, and so you really need to have that knowledge that maybe you gain from single family investing.
That's the way, that's the way I think it works. Like me, I've been approached by syndications. I just don't do it myself just because I get rich in my niche. I know a great single family deal and I love them.
Yeah. Now,
And I don't want to share.
Is there you talked a little bit about risk, but would you say there's kind of like equal risk for both kinds of deals, or
No, because the 30-year fixed mortgage. The biggest risk to a real estate investor is that not that the asset fails, but their liquidity fails and their lending fails. So look at all the houses that got foreclosed on in 2008, right?
Yeah.
So they lost half their value between 2008 and 2011. What's going on with those houses now?
Recovered their value, hopefully.
Doubled their value.
Doubled their value.
Doubled their value from their like 2000, their before crash price, right?
Yep.
And so, okay, cool. It's not the real estate that's the problem. What's the problem?
I guess you just need to be able to survive that downturn in the economy.
The borrower's liquidity was the problem. And the lending, the balloons on the payments were the problem. So you buy a house, there's some catastrophic economic event, you're not liquid, the house has maybe lost value, and the bank now gets to change terms. That's what hammers real estate investors. So if you take that 30-year mortgage and eliminate the balloon risk, it's really hard to get foreclosed on if you're already liquid and you're a high producer.
Right. Yeah. Wow. Okay.
So that's what I got. Hopefully I answered some of the listeners' questions.
Nice. Yeah, I think so. I definitely think that question is out there. And really, I mean, for me, it was just really helpful to have that illustration of the wealth pyramid and like why it makes sense to do it that way versus, I mean, it's so commonly what's done. Hey, your employer gives you your Roth IRA. You're starting to put money into it. You think you're on your way to building wealth, but you need those four pillars. So, man, that's
And then I think we'll do a podcast on this. I'll write this down. But like, there's also a thing called velocity of money.
okay.
And then when your cash is locked away in illiquid, so we'll do this on this episode. But essentially, I bought the house I currently live in 2011, and I knew I bought it for half off. It was a foreclosure, and so I lived in it for 6 months. I was able to gain equity just from painting it and cleaning it up. So I bought the house for $400. 6 months later, it appraised at $700. I then go to the bank for a line of credit. I take that line of credit. I take $250K, and I start buying rentals. And I do BRRRRs, and I refinance my cash out. I put it back into my house. I then use a line of credit to do a new kitchen and bathrooms, right? Which makes the house appraise more.
Right.
So my line of credit went from 300 to now it's like 400 or 500. I take that cash. That's how I bought so many houses in 2016. I take that cash and then I start borrowing again.
Right.
And so since that my cash wasn't locked up in an IRA, I have now, my cash is moving through different assets.
That's what you mean by velocity? The fact
Yes.
you're able to move it? Okay.
Move it around, all that stuff. The problem with the 401k is it's not liquid. Can't be controlled. The velocity on it is zero.
Yep. Well, all right. Well, I'm excited for that one.
Yeah. So if you found value in this podcast, please like, share, subscribe, tell all your friends. And then, like I said earlier in the podcast, if you think you'd like to get started with me or my team, please go to jimmyvreeland.com/get started in real estate. And you'll talk to one of my team members, and we'll see if we'll be a good fit for each other. Otherwise, hopefully you just keep enjoying the podcast.
Well, we'll see you next time.
See you guys. So if you like what you heard today and you want to learn more, sign up for a discovery call with one of the Vreeland Capital success coaches at jimmyvreeland.com.